Welcome to the deep dive. Today, we're jumping straight into Cadence Design Systems, CDNS, and their Q3 2025 results. And the headline, a really solid beat. Non-GAAP EPS hit $1.93.
Yeah, that's $20.14 above the $1.79 consensus. Pretty
Yeah.
significant.
And revenue also came in slightly ahead, $1.34 billion versus the $1.32 billion expected.
Right. That kind of beat, especially on the EPS line, it signals more than just, let's say, a good quarter. It hints at real momentum.
Absolutely. And you see that when you look year over year, don't you?
Definitely.
Revenue was $1.339 billion this quarter. Compare that to Q3 last year, $1.215 billion.
Nice job.
And the non-GAAP EPS. That climbed from $1.64 a year ago to this $1.93. That feels like strong growth.
Yeah, it is. And the key thing driving that is the operational leverage. The non-GAAP operating margin reached 47.6%.
Okay, 47.6%. How does that compare?
Well, it's a good step up from 44.8% in the same quarter last year.
Yeah.
But honestly, the really big news, the structural story here is the forward guidance. They raised it.
Ah, okay. So it's not just a one-off beat. They're actually lifting their forecast for the whole year.
Exactly. Raised expectations across the board, which shows real confidence.
So what are the new numbers we should be looking at for FY 2025? How much higher did they go?
Okay, so for the full year non-GAAP EPS, the new range is $7.02 to $7.08.
Right, $7.02 to $7.08. The midpoint there, $7.05. How does that stack up?
It sails past the old consensus, which was around $6.93, so a meaningful increase.
And revenue.
Revenue guidance is also up. Now $5.26 billion to $5.29 billion. The street was at about $5.25 billion.
So this basically translates to what kind of annual growth?
It puts them on track for roughly 14% year-over-year growth. It signals, strong commitment backed by what they're seeing right now.
Okay, that makes sense. And just to round out the picture for you listening, let's quickly touch on Q4. What are they expecting just for the next quarter?
Yeah, the Q4 outlook suggests things keep rolling. They're forecasting revenue between $1.405 billion and $1.435 billion.
And the EPS for Q4?
Expected between $1.88 and $1.94 on that non-GAAP basis. Seems solid, maybe even a touch conservative heading into year-end.
Right. And you mentioned confidence. What's underpinning that confidence? Where does that operational strength really come from?
Well, a huge part of it comes down to visibility. And that brings us to the backlog. Management reported a record backlog.
Record how big?
$7.7 billion at the end of the quarter.
Wait, $7 billion. Wow. That sounds massive for, a company mostly in software and IP. Is that all new deals, or is it the usual long-term license renewals?
That's a fair question. Look, the ADA business model is inherently sticky, right? Customers sign multi-year deals, especially for these complex chips going into AI and HPC. So that $7 billion reflects those long-term commitments.
Okay, but how much translates into near-term revenue?
That's the key part. They expect to actually recognize $3.5 billion of that backlog as revenue over just the next 12 months.
Okay, so $3.5 billion is essentially locked in for next year already. That gives them a huge cushion for hitting those targets.
Precisely. And add to that, the high level of recurring revenue. They mentioned trailing 12 months. Recurring revenue is sitting at 80%. Very strong.
So massive backlog, high recurring revenue. It paints a picture of stability.
Exactly. And when you combine that stability with the 47.6% non-GAAP operating margin we talked about,
Right.
It really highlights the strength of their model.
You mean just cutting costs?
Not really, no. I mean, cost control is always part of it, but for Cadence, it's more about the scalability of the software business itself.
How so?
Think about it. The R&D cost to create these incredibly complex EDA tools is enormous, sure. But once that software exists, the cost to license it to one more customer, it's tiny.
Right. The marginal cost is near zero.
Exactly. So as revenue grows on that mostly fixed R&D base, the margins just naturally expand. It signals scalability, high barriers to entry, all the good stuff you want in a leading software company.
Makes sense. Okay, before we get into the strategic stuff, maybe we should quickly clarify for you why companies like Cadence focus so much on non-GAAP numbers, especially that operating margin. Why exclude things like stock-based compensation? Isn't that a real cost?
Oh, it absolutely is a real expense. And that's why you always look at both GAAP and non-GAAP figures. But for tech companies, especially in growth mode,
Like Cadence?
right, they rely heavily on stock compensation to attract and keep top engineering talent. The people designing the tools that design the chips. So by excluding it, Non-GAAP aims to give a clearer view of the core operational profit from just selling the software and IP itself.
So it helps compare apples to apples with peers without noise from stock comp or big acquisitions.
Basically, yes, it isolates the core business performance.
Got it. Okay, that actually leads us nicely into the strategic moves driving this growth. The CEO mentioned deepening strategic relationships across the AI ecosystem. Let's unpack that. What are the key growth areas?
Well, there are a couple of big ones. First, their IP business. The pre-designed blocks chip company's license. That showed really strong momentum. And it got a boost from acquiring ARM's Artisan Foundation IP.
ARM Artisan IP. What exactly does that bring them? What kind of IP is that?
It's foundational stuff. Really critical building blocks for modern chips. We're talking standard cell libraries, memory compilers, IOs, things designers need to build complex SoCs.
Sort of like essential Lego blocks for chip design.
That's a good analogy, yeah. By integrating this, Cadence makes its overall design IP portfolio more comprehensive, more essential, especially for customers using the most advanced manufacturing processes.
And it sounds like their hardware business is directly benefiting from that AI focus too.
Definitely. They reported a record Q3 for hardware, and they specifically pointed to expansions at AI and HPC customers.
HPC meaning high performance computing.
Mm.
So the big data center guys, the hyperscalers, AI researchers.
Precisely those. These new AI chips are incredibly complex and large, so customers need more of Cadence's advanced hardware, like emulation and prototyping systems, just to verify the designs work before they spend millions taping them out.
So it confirms the CEO's point. AI is driving demand for their high-end tools.
Correct. And they aren't just strengthening their core, they're also expanding outward strategically.
Moving beyond just chip design tools.
Exactly. They signed a deal to acquire Hexagon's D&E business that's design and engineering. This is Cadence stepping more into the physical world analysis.
Okay, Hexagon D&E. What kind of tech is that?
It brings capabilities in structural analysis, multi-body dynamics. Think simulating how physical parts behave under stress, vibration, how complex mechanisms move.
Huh. So moving from designing the chip inside the phone to analyzing how the whole phone handle's being dropped or how a car chassis flexes.
You got it. It pushes them deeper into system-level design and analysis. This means they're now competing more directly with companies like ANSYS or Siemens in the simulation space.
So they can offer a broader package, from the transistor all the way up to the full system simulation.
That's the goal. It makes them much more valuable for customers designing really complex systems, think autonomous vehicles, aerospace, that kind of thing. It's a significant expansion of their addressable market.
Interesting move. Okay, shifting gears from strategy to geography, there was a really surprising shift in where the revenue came from in Q3. Quite dramatic, actually.
Yeah, this one definitely warrants a closer look. China revenue jumped significantly. It hit 18% of their total revenue this quarter.
18%? What was it before?
Just 9% in Q2. And it was 13% a year ago in Q3 2024. So it basically doubled its share in just one quarter.
Wow. And what happened elsewhere?
Well, as China surged, the Americas share dropped noticeably. It went from 49% in Q2 down to 43% in Q3.
Doubling revenue share from China that quickly. That feels like it carries some geopolitical risk, doesn't it? What do you think is driving that surge?
It does raise questions, for sure. On one hand, it shows huge demand. Maybe it's aggressive chip initiatives within China. Maybe some customers are buying ahead due to trade uncertainties.
Or maybe both.
Could be. But on the other hand, relying more heavily on a single region, especially one with a complex political and regulatory backdrop, adds volatility.
So the question is sustainability. Is this 18% a new normal or just a temporary spike?
Exactly. We need to watch if this reflects truly deeper, long-term relationships or if it's more stimulus or inventory-driven. But it certainly underscores how critical EDA tools are globally, no matter the politics.
A fascinating dynamic to track. Okay, before we wrap up, let's give you some context on the stock itself. How's CDNS been performing?
Well, the stock closed recently around $351.40. It was actually down a little bit, about 3.6% over the prior 3 months.
Okay, a recent dip. But the longer-term picture?
Much stronger. Over the last 12 months, the stock is up a very healthy 39.02%.
So nearly 40% gain in a year. The market seems to like the long-term story despite any short-term wobbles.
Yeah, it looks like investors are focused on those strategic plays, the AI tailwind, and especially that massive, reliable backlog. They see it as a solid long-term growth engine.
So let's pull it all together for you. What's the main takeaway here? Cadence didn't just beat Q3 estimates and raise the full-year outlook significantly.
No, it seems they've really reinforced their long-term position. That $7 billion backlog provides serious financial stability.
And the strategic moves into critical IP, hardware for AI, and now system-level analysis really cement their role as a key partner in that whole AI ecosystem build-out.
Agreed. Which leads me to a final thought for you to mull over.
Okay, let's hear it.
Right now, Core EDA, their traditional chip design software strength, is still the lion's share of the business, about 71% of revenue.
Right.
But this newer system design and analysis category, the stuff including the Hexagon acquisition tech, is currently around 15%.
Okay, 71% versus 15%.
So the question is, given Cadence's growing focus on these AI-centric transformational solutions and that record hardware quarter driven by AI HPC, how fast could that 15% system-level category grow? Could it eventually start to challenge or at least significantly rebalance the dominance of Core EDA in the coming years?
So the shift from just designing the chip to simulating the entire system, that's the core strategic evolution to watch.
That's what I think. It's potentially the next big chapter for Cadence.
A great question to leave us with, really framing their long-term strategy. That wraps up our deep dive into Cadence Design Systems Q3 results. We definitely encourage you to look at the source materials yourself. Thanks for joining us.